Hello, Shek here. Welcome to this week's Flash Liquidity Blows. And I'm going to discuss the importance of understanding global liquidity flows at a time of a potential pivot. I considered calling today's Flash when Barry met Sally, my two fictional traders, and the conversation they might have had when Barry, buy the dip, met Sally, sell the rally. More of that later. But to begin with, we need to understand the US assets have been a dominating magnet for attracting global liquidity, certainly since the post-COVID years and arguably for 5 or 10 years before that, and for good reason. The US has had the most dynamic economy. Earnings have been at a greater rate than anywhere else in the world. They've got the best tech companies at the time of AI. The equities have deserved a higher valuation. And when we think, certainly through the post-COVID years, why global equity asset managers have been underweight Asia, China, Japan, underweight Europe, and very overweight US, it's easy to understand why. The opportunity cost of owning long US assets has been very low. And when we think about the global fixed income managers, the US's strong economy has been able to sustain much higher rates, offering a better risk-free yield. And the oldest carry trade in the world, the yen carry trade, has been a consistent and massive source of funding. Borrow size in yen, leverage, and then lend that money to the US, to the Fed, or further out the credit risk curve, or into equities and other risk assets. So it's easy to understand also why fixed income allocators have been overweight the US corporate and treasury market too. You simply can't underestimate how much capital has been sucked into US assets across all asset classes. So far, so good. Now, the cornerstone of all these flows has simply been the strength of the US economy and the EPS growth. As Barry Buy the Dip will tell you, whenever there have been worries about a recession in the past, they've been short-lived, they've never materialized, and Barry Buy the Dip's been right every time. But when the macro data starts to soften, at a time when tariff uncertainty remains elevated, coupled with other geographies around the world showing signs of improvement off a very low base, capital flows can start to turn. And this has occurred with the US economy slowing, not nosediving into an obvious recession yet when we look at the hard data. And when capital flows reverse, equity markets can move very quickly. And we've seen a shockingly fast 10% correction. And now if we look at the first couple of charts, these are from the Bank of America FMS, you'll see what I mean. So from December to March, we've seen the record rotation out of US stocks. Now, there isn't an obvious big reason why. It's more of a number of factors all working at the same time. You could start with even DeepSeek, because that was the first event that questioned that more money meant better AI at this stage, and obviously the most crowded trades are the big US hyperscalers and the data center trade. The second chart is a nice graphical representation of showing what's happened in March. So when we have these liquidity events, no one really cares about the charts or even the fundamentals in the short term. It's just very, very simple. All the marginal buyers of the last 5 or even 10 years become marginal sellers at the same time, top slicing their US equities overweight and rotating elsewhere, Eurozone, China, Japan, other parts of EM. There's a pension funds, insurance firms, defensively moving a couple of % out of equities into fixed income, or they could be global equity asset managers just top slicing and rebalancing their portfolios. The problem is they all do it at the same time. So we've had a slowing US economy, all right? Nothing too bad yet, tariff uncertainty, and there are a couple of other factors I'd like to discuss. And when relative rates of change move, it leads the likes of Citi strategists cutting US equities from overweight to neutral, raising China to overweight. Now, of course, they're not saying the US economy is weaker than the Chinese economy, but everything is relative value and the opportunity ahead, the true opportunity cost of capital. And maybe Citi think it's arguably easier for the Chinese market to rally 10 or 15% than the US as it's starting to slow. And if you look at the next chart, also from the FMS, you can see what I mean. So a large proportion of people obviously think the US economy is weakening, and the rate number of people who think the Chinese economy might be improving grows. Liquidity flows. Now, when you look at the next two charts, this is the yen. And you can see that interest rate expectations have changed. And if you look at the right-hand chart, you can see that rate of change is quite rapid. And this has huge implications for the yen carry trade, right? And as the title says, a policy hike clue in plain sight. So what's happening in Japan, and we're not talking about whether the economy is really strong enough to sustain materially higher rates, it's all moot. If rates go up, the carry trade looks a lot less attractive, and then you can see more unwinding of that, which will lead to more selling of US assets. So the market's corrected not because US companies are lowering earnings yet, or anyone has any clue as to the longer-term impacts of tariffs, but there have been 3 or 4 rates of change that cumulatively have led to phase 1 flows out of the US assets. And this is when Barry's not quite sure what's going on. You can look at really good stocks like Arista Networks or Vertiv. These are stocks in the right place with good quants. They've fallen 35–40%, but for some reason, they're just not rallying. And you buy the dip, and you look at the charts, and they have these little ski jumps. They've sold off hard, and Barry's in. All the Barrys are in, and we're now waiting for the cavalry to arrive. And the problem this time round, just by observing the market, is it doesn't appear that even at the lower levels, a lot of money is coming into the market. It's all very well for the short-term traders and the algos to jib and job about, but for these stocks to retrace and head back towards where they were, you need proper money to come into the US market. And there's enough anxiety for people just to wait and see. Now, when we look at this final chart, you can see that Barry has done what he's been told. So we've got the professional institutional money managers of size are selling US equities, and Barry and his mates are buying. He's doing exactly what he's supposed to do. He's doing what's always worked. And the message to Barry is you've got to be aware of the global liquidity flows, and great importance is understanding when long-term trends start to turn. Now, if I had the conversation now between Barry and Sally, Barry's saying, it's typical old bears. It's only old miserable traders like Shek who always thinks the market's going to collapse. Sally might say, well, Shek is not really bearish. He's just really aware that if the hard data of jobs and spending degrade further, the equity markets might move harder and faster to the downside because the flows of liquidity will enter phase 2. Yeah, but Jerome Powell said that we aren't going to have a recession, so Shek is wrong. Yeah, it's not really about are we going to have a hard landing recession. We can see what's happened, Barry, when liquidity flows. People need reasons to invest in the US, and if the macro's declining, then they won't. Now, they might not sell aggressively, but buying the dip's not a guarantee that the market's just going to keep going up. But every time the market sells off, it all calms down and it rallies. How would Ed position in a market like this? Well, as a professional portfolio manager trading options, it's never about being long and the market goes up or being really short and the market goes down. It's about having sensible, intelligent structures. And Ed might think being diversified makes sense as always, and also having some bear market overlay trades might make sense. These would be out of the money spreads. It could be in IWM, shorting the Russell ETF. It could be in a mid-cap bank, because the dominoes could fall. Now, we've had this discussion before about jobs and spending, and I say it again, if the jobs market really does stay strong, and AI redundancies and Doge really aren't an issue, and if everyone has confidence and continues to spend as they have done, you're absolutely right. The economy will be fine. The equity market might be fine. But there's a big difference between not having a big recession and the market going up. Just because the economy is slowing down but doesn't have a recession doesn't mean that the market's going to start rallying hard and making new highs. So I think what Ed's saying is, I think people underestimate the domino effect if the economy degrades further. And through the last 4 years, we've seen delinquencies go up, bankruptcies go up, private equity deals go under, and it's all been contained. We've had problems with commercial real estate, and of course, nothing's panned out. If the economy degrades further, the stress in the bottom half of the US consumer group could break quite quickly. There's been some data recently about people who have bought a starter home in the last 2 years, having only 1 or 2 months savings for mortgage payments. We know there are loads of people who are working 2 or 3 jobs to get by. If we start to see a step change in unemployment, retail spending will follow, and then a lot of credit events might happen. So as well as staying diversified with a bit of a bear market overlay, you really must keep watching junk bond spreads. Remember, in the credit markets, yields and spreads have been so low because so much liquidity has been pouring into the market. Credit is always fine until it's not, then it moves all at once. So I think to stay relatively well diversified with more than downside protection is the way to go. But as always, try and tune out from all the chit chat, follow the hard data, and make sure your book's going to participate well if the unimaginable happens. Like any old trader will tell you, don't waste a good crisis, don't waste a good potential sell-off. Thank you very much to all the Barrys and Sallys and diversified portfolio managers out there.